Immigration in Canada has always been a hot button issue, but Canada's immigration and international student programs are getting pretty crazy, popping up in the news almost constantly with protests, policy changes, and it's becoming increasingly confusing. And now we're hitting a record number of international student applications in spite of the government imposing caps on international students. In this video, I'm going to discuss what is happening with the international student market and program right now. I'm going to talk about how it'll impact the real estate market and how we can make informed real estate investment decisions moving forward. So stick around because I'm going to explain the one key investment opportunity that I see evolving from the economic trend that we're seeing in Canada right now. If you prefer to read along, I posted an article on my Substack that has most of the content that I am going to be covering today. It's also posted on my LinkedIn and on my Twitter. If you're watching a 5 to 10 minute version of this video on Instagram, Threads, or TikTok, there is a longer version on my YouTube channel. And if you're watching the long version on YouTube, there's probably an even longer version in our online community at realist.ca. Just a quick look at that. We have hundreds of hours of content just like this, which is more specifically tailored to helping you make informed real estate investment decisions. Okay, first let's talk about the population growth cap. The Canadian government website stated that they're going to stabilize growth and decrease the number of new international student permits. You can see the article on the Government of Canada's website here, published in January of 2024. At the same time, it says starting in September 1st, 2024, international students will no longer be eligible for post-graduation work permit. We've seen a number of protests evolving as a result of this, asking for transparency because a lot of people were promised by recruiters for these institutions that this was a path to residency in Canada, and it's turning out that that's not the case. And so rightly, they're protesting about the lack of transparency and the misinformation that they've been given. And this whole thing's really become a big mess and a huge hot button issue for politicians right now. The government has also been toying with a new idea, which is that they could decrease the number of temporary residents by making them permanent. So taking a lot of these non-permanent or temporary residents, so your LMIA, labor mobility, temporary foreign workers, your international students, etc., taking them and actually making them permanent residents or giving them permanent residency. Now, it is worth taking a look at this chart from the Bank of Canada, which shows the growth in the population of non-permanent residents in Canada. And it shows how the red bars here you can see are decreasing over the next 3 years. So we're actually going to see a net outflow of non-permanent residents, which is your students and temporary foreign workers, because the government is trying to get that number down from 6.2% to 5% of the total population. And so if they move those non-permanent residents into permanent residents, we would also see a decrease in the number of spots available for permanent residents, which means that it would actually exacerbate the impact of this policy by shrinking population growth very substantially in Canada for the next 3 years at a minimum, based on what they're proposing in policy. This comes from the Bank of Canada's quarterly monetary policy report, by the way, which whenever a report like this comes out from the Bank of Canada or CMHC, I typically will do a exhaustive video on it for our course community at realist.ca. Getting back to the content from my article on Substack, you can see here they're mentioning a net zero first year growth model, which shows that they want one student leaving for every one student coming into Canada. So the study permits that are expiring are 485,000. They have a bunch of group exemptions and a new approval rate. And so functionally what this equates to, and this comes from the Government of Canada's website, is a reduction in the international student population of 42%. But then they go on to have these allocations after what they call initial adjustments. And it looks like it'll actually end up being closer to 28%. Now, these numbers I really want you to look closely at. So the provinces where you're going to see growth in international students are Alberta plus 10%, Newfoundland and Labrador plus 10%, Quebec plus 10%, and Saskatchewan plus 10%. You'll notice that I didn't mention the territories there because I'm going to do them separately. The provinces where you're going to see a decrease in international student population, British Columbia minus 18%, Manitoba minus 10%, New Brunswick minus 10%, Nova Scotia minus 10%, Ontario minus 41%. Take that in. You're going to see a 41% reduction in international students in the province of Ontario. Prince Edward Island minus 10%. Now we get to the crazy part, where in the territories, in Northwest Territories, we're expecting to see a 4,900% increase in international students. In Nunavut, we would see a 6,500% increase in international students. And in the Yukon, we would see a 205% increase in international students. Now, to be fair, the number of students is like 333 in Northwest Territories. So it's easy for these numbers to really look extreme, but it's only in the hundreds of people. The reason I think a lot about international students is because landlords really like student rental properties. And they like it because students are higher turnover tenants, which means that landlords can reprice their properties more frequently to escape rent control. So they can reprice after every 2 years for these college programs or 4 years for university programs. And landlords who are renting to students feel like they're less likely to be demonized for being parasites or hoarders of housing or housing destroyers, given that they're not renting to families or taking family homes. The one thing I will add here, and this is one of my favorite visuals that was posted by Mike Moffat on Twitter originally and can easily be found on Reddit now. So if you're having a hard time understanding the phenomena, I would want you to look at this table. So this table shows the change in international student growth by post-secondary institution in the province of Ontario. There's a couple of notable ones. Conestoga College, as an example, saw a 1,500% increase. Loyalist College saw a 4,600% increase. Sault College in Sault Ste. Marie saw a just shy of 4,000% increase. And so I would encourage you to look at these institutions and then look at the real estate markets in which they exist in and tell me whether or not you think there was a correlation of the impacts in these markets. And similarly, are we going to see a contraction in these markets as a result of these reductions in international student populations, which is obviously causing a lot of upward pressure on demand in those markets, which is very visible in Ontario, especially like your Sault Ste. Marie, North Bay prices doubled, if not tripled, during that period of time where we saw this massive international student growth. A lot of college student rental investors are cash flowing exceptionally well. It's one of the only ways to cash flow in the Ontario market, and we're at risk of seeing that change. One of the pieces that I think is interesting, and I'll probably just do a whole separate video on this, but I did do a video of this in realist.ca, which is this report from the Fraser Institute called Canada's Growing Housing Gap. And it compares Canada's population growth to housing completions from 1972 to 2022. And this is where we really get this famous derivative chart. But they go on a province by province basis and look at which provinces are seeing the highest amount of excess demand, basically relative to their ability to produce supply, which is new housing. And New Brunswick is actually seeing the most population growth relative to housing completions at 11 new people per new home being built. And this accounts for both interprovincial and international migration, by the way. Here's a table that shows the breakdown by province. So the highest provinces being New Brunswick at 11.3, Newfoundland and Labrador at 9.7 new people per unit of housing being built, and Saskatchewan being 8.2 new people per unit of housing being built. So we've got this international student cap that's taking place, yet somehow we are seeing a record number of international study permits being issued in Q1 of 2024. So this is obviously pretty confusing. This chart comes from Alex or Exelon on Twitter and Substack, one of my favorite accounts, and him and I do some work together. I think we're seeing a phenomena of like rushing the gate, which you would call, when people rush the gate at a concert to try and get in a hurry. It feels like up against this cap, hopeful students are applying and being issued study permits in record numbers because they're applying in record numbers because they're fearful that the more competitive environment for international study permits is going to make it more difficult for them in the next few years. As a consequence of this policy, we've seen more people apply, even though the policy was designed to reduce the total number of international students. This is translated to a post from Carl Stack or Chris Brunette from National Bank Finance and Economics, which shows how Canada's population growth just hit another new record on a quarterly basis. 40% jump from 2023's first quarter growth. The National Bank also observed in one of their reports that a lot of our GDP is coming from record population growth in Canada. So we rely on this to grow our economic output. And the consequence of this is falling GDP per capita. And I promise that I'm setting this up for a meaningful opportunity for you as a real estate investor. So falling GDP per capita is interesting because without population growth, I get that Canada would be experiencing something of demographic crisis. We have an aging population. This is generally called an increased dependency ratio, insufficient labor to take care of the aging population, issues with pension capital, insufficient payment into the pension system, which is being drawn out by retirees, insufficient labor and capital to keep healthcare serving the aging population. But the other piece when you think about GDP per capita is, the OECD says GDP per capita is a broad measure of average living standards or economic well-being. If we look at the way that Canadians spend their money, about a third, the largest portion of our income, is for housing. I would say this is probably significantly higher now. I just don't have updated data, but Canadians typically would spend close to 30% of their income. That's what's considered affordable for housing. And so when you think about a reduction in GDP per capita, it is most likely to materialize in the largest portion of our household expenditures, which is your shelter. What does this mean? As we start seeing housing unaffordability climbing, people are getting less and less able to buy houses because the GDP per capita, the wealth that they're able to extract from the economy on an individual basis, is declining. I don't think I need to dive into how we got here, but we have far more demand, far more people moving to Canada than homes that we're able to build. And so this creates an excess demand scenario. CMHC believes that we're capable of building 465,000 homes per year, which is still less than what we actually need to be building. And the reality is we're not building that. And they mentioned in the same report where they outline that housing starts have not kept pace with resource allocation. Employment in residential construction, this red line here, is increasing and continuing to increase out of the pandemic. And yet GDP from residential construction and housing starts are both in decline at the same time that you're seeing that increase. And so the input labor, construction labor, is not producing relative output. So there's a couple of different reasons why this could be the case. The first one would be maybe labor is becoming less productive, reaching a point of diminishing marginal returns. The second one is that residential construction labor would be shifting away from housing starts to other jobs such as renovation, so improving existing stock rather than building new stock. I also don't think this is likely. We're seeing a reduction in renovation spending in Canada. The two other pieces that to me are the more likely causes here, or contributing factors, because I get in trouble for mentioning cause on these things, is that material inputs are becoming less productive as a result of cost inflation. So every unit of concrete or lumber or whatever other input, not just the labor input, because everything is composed of both capital and labor, and capital being all the other expenditures, those are becoming more expensive, which means that it's difficult to produce as much because it's more expensive. The other piece is that capital inputs, so the money that you're putting into a deal, are becoming less productive as a result of increased capital costs, so interest rates going up, and fees such as development charges. Development charges being an especially important one to think about because they're continuing to increase. At the same time, we're seeing a huge drop off in the condo pre-construction sales environment. The housing starts that we're seeing today sold in, on this chart, you could see them, which were really good years for the sales of pre-construction condos. So the fact that we're seeing a reduction in this type of supply in the future tells me that we would be facing a supply shortage, an exacerbated supply shortage compared to what we're seeing today in the future over the next couple of years. And in the absence of supply, if you're not seeing supply keeping up with demand, excess demand should either influence price levels to rise, so prices should go up, or it should influence more supply to be built to meet demand. But neither of these things is happening right now. So and the only supply that we're seeing is a lagging impact of supply from our previous housing model, in which units were pre-sold to buyers, most commonly investors, and their capital would be used to fund the construction of the building. I outlined this in my most recent video, so I'm not going to revisit that. So investors would be willing to make the trade-off of being cash flow negative. We knew 50% of investors were cash flow negative for new construction condos, and they would make this trade-off because they would be getting capital appreciation. In this model, a buyer would buy a condominium for, let's say, an all-in cost of $600,000. It would cost them about $3,200 a month to own that after they're down. So their mortgage payment would be $2,700 a month at a 5% rate on a 25-year amortization. Their condo fees, taxes, maintenance, and insurance are another $500, and they would be able to rent that condo for $2,500 a month. So that illustrates to you how they would be cash flow negative of about $700 per month. Statistics Canada shows that more than half of Toronto condos are investor owned. There are thousands and thousands of examples like this actively delivering rental housing to the market below the cost of ownership of that housing. These investors are willing to do this because they felt like they'd make their money as the condo units went up in value over the course of their ownership. During that time, they'd also be receiving $480,000 of principal pay down over 25 years, and they'd pay about $350,000 in interest for that privilege. This is, in effect, from my perspective, a socialization. This is a socialization of affordable housing. The investor absorbs the loss, and the end user of the condo, the tenant, gets to occupy it at lower cost than the ownership of that same unit. Who wins in this scenario? I think the tenants maybe win. I don't think the investor really wins. I think banks definitely win. And as a fan and a shareholder of Canadian banks, I don't really see an issue with this. What we're seeing taking place now, a lot of this demand is being backfilled by purpose-built rental housing starts, increasing substantially for apartment type properties. A builder would build a condo building, and then the investors, the owners of that asset in the fullness of time, would be individual investors, a lot of foreign capital, a lot of Canadian investors using HELOCs to buy a second property, etc. Now, in the absence of that demand, the government is asking developers to absorb the cost of delivering this affordable housing. And the reason that we're seeing this purpose-built rental created is because MLI Select Financing, CMHC's MLI Select Financing, is making it compelling for developers to do that. If they meet certain criteria, they're able to get the best interest rates in the market, the highest loan-to-value ratio, and the highest amortization. So loan-to-value is up to 95%, and amortization is up to 50 years. A 50-year amortization allows a bank to collect 2.26 times more interest over the ownership of that rental project than when compared with a 25-year amortization. So the banks continue to win in this scenario. It also allows developers and eventually owners to privatize the creation of affordable housing and spread it out over an extended timeline, which is insured by taxpayers. So in this scenario, a developer could build the same project that I mentioned before and carry the property on a monthly mortgage payment of $2,000 rather than $2,791. And they do this by halving the principal payment. So 25 years is half of 50-year amortization. So your mortgage principal is getting paid down at half the rate. And so on a 50-year amortization, you're paying half the amount of principal. And this reduces the monthly burden, the monthly cost for the developer to own this, or the new purpose-built rental owner to own this. And now it becomes a profitable venture. CMHC will only deliver these if they hit a certain debt service coverage ratio. So they need to be about 10% cash flow positive. So in the absence of cash flow negative investors willing to socialize the cost of affordable housing, we're expecting developers to bear that burden by spreading that risk across 50 years. And it seems to be working based on this chart. Unfortunately, we're still underbuilding to the point that our housing supply deficit hit a new record in Q1 of this year. I posted this chart. I actually think Pierre Polyev, I feel like he's reposted like 3 charts that I've posted. So I think he's maybe following my account at this point. But just as much of this deficit is happening as a result of demand side, population growth, not supply side. So what happens next? This is really the point. This is a very long video. It's very exhaustive. What does all of this mean? How does this create opportunity for us as investors, right? I'm going to summarize and examine the setup that I mentioned here before. So we already had too many people for existing supply in Canada. We just saw a record quarter of growth in Canada again, after we set multiple records quarterly last year. We're going to continue having more people in Canada, even though it's at a reduced rate moving forward. And we're building a record low amount of housing relative to each new Canadian coming here. So the answer from my perspective is it's hidden in plain sight. It's so simple it might surprise you. So let's look at London. London has this common housing type called a flat, right? I'm sure you've heard of it. A flat is a self-contained housing unit that occupies only part of a building, a house. In a lot of cases, it was these old row houses that were cut up into multiple units. And why did this happen? And when did this happen? So let's go back 100 years and let's look at London when it was experiencing the same growth that Toronto is experiencing today. They are just getting back to the population that they saw during that period of time. And my thought is that Canada could see the same thing happen. So in Canada, we have enough space to make this happen pretty easily. And in fact, we actually have the third largest house sizes in the world, behind only Australia and the US. And on a square footage per capita basis, again, we lead the world behind only Australia and the US. And a lot of this supply is held by baby boomers and Gen Xers, who are now becoming empty nesters and preparing for retirement, and will be eventually vacating those homes, although most of them say that they're not going to do that. So as a result of them owning those homes and those nests emptying, the number of people per household in Canada has been falling since 1850. And this phenomenon was the exact same in the US until 2015, when the number of people per household started growing for the first time ever, which is something I expect will take place in Canada basically from today onward. And it's extremely visible in policy what the governments are trying to do. They're actively encouraging the upzoning of neighborhoods to allow for multiplexes, functionally allowing existing housing to be cut up into the flats that I mentioned. This would be the most agile type of supply that you could possibly build. The structures often already exist in many cases. It's the cheapest type of housing that you can build. It doesn't disrupt the character of the neighborhood too much, so it's easier to get past NIMBYs than a high-rise building. It's built at a significantly lower cost than a high-rise building, and in many cases where we're seeing these upzonings to fourplexes or multiple units in residential neighborhoods, it is fully exempt from development charges, which means that you get a huge discount when compared to the high-rise next door to you or around the corner from you, because you don't have to pay development charges if you're building a multi-unit building or converting an existing residential lot or residential building to a multi-unit building. Interestingly, the Annex in Canada, one of Canada's most famous neighborhoods, was built this way. It was all these old massive Edwardian mansions that were gradually converted to multiplexes in this fashion. A lot of U of T students lived there. This is one of Canada's most famous neighborhoods, and it was admired for this character by the legendary urbanist Jane Jacobs, who I would say is relatively qualified to judge character of neighborhoods. So the easiest way to look at this when you think about Canada heading in the direction of London X amount of years ago is, the way I think about it is, and a lot of people like to say, oh, it's you'll own nothing and be happy, World Economic Forum, whatever. And maybe that's the case. I don't know. But I look at this chart from the OECD that shows housing tenure distribution. So it's home ownership by nation. And Canada's kind of close to the middle right. And everyone to the right of us, I would say, are countries that Canada politically aims to be like. So to our immediate right, you see Ireland and the United Kingdom, which is the flats that I just mentioned. Then you start to see Iceland and Finland and Australia and the Netherlands and Denmark and Austria and Germany and Switzerland. And I would say that these are all places on earth that Canada politically aspires to be like, at least with the way our policy direction is heading right now. And so these are all countries that experience the same growth and the same economic setup that we're seeing, population growth, inability to deliver supply to that population that we're seeing right now. And we can rewind 100, 200 years and look at what happened to these countries and learn from it. And that is what's going to happen to Canada's economy. So my predictions are that our homeownership rate will continue to fall. Our square footage per capita will continue to fall. The number of people per dwelling in Canada will increase, and baby boomers will sell their oversized homes, and investors will convert those homes to multiplexes. Taking existing supply and increasing its density is one of the best ways to make money in Canadian real estate in 2024, 2025, and beyond. A lot of people think that buying one unit and holding it and speculating that the value will go up is the best way. It is not. Increasing density and capitalizing on the fact that people cannot afford the unit that you would be speculating on and making affordable housing is the way to create not only social value, but economic value for yourself and investment value for your portfolio. There's actually a great tool that I would recommend that you check out for this at rehousing.ca, which shows you actually how to multiplex the 12 most common homes in the Canadian built form landscape. So I would highly encourage you to check that website out. That's all I have for you today. As always, please make sure to like, comment, and subscribe. It really helps me grow my channel. It helps me stay incentivized to continue making these videos because it is very difficult sometimes. And if you prefer reading the content that I'm making, these are basically derivatives of articles that I post on my Substack, which I typically go out 24 hours before I make these videos. If you are interested in learning more about how we use data-driven and economically driven decision-making like this to make informed investment decisions, I would love to book a consult call with you to see if you would be a good fit for realist.ca. So check out our website, realist.ca. You can join our free community. We have free monthly webinars to help you grow your skill set as a real estate investor.